Do you think that you're paying more in taxes than you should? It's a common question I get for those who are thinking about transitioning into retirement because they want to keep more of the money that they earn and pay less in taxes. Well, in this video, I will be interviewing one of the preeminent tax specialists in the Boston area, and he will share with you some of the common mistakes people make that may cost them thousands of dollars in their retirement chapter of life. If you're interested in timely and up-to-date information on retirement, income planning, or any of that, make sure that you subscribe to our channel and hit the notification bell to make sure that you're alerted to when new videos are posted. Joe, so glad that you're here with us today.
Good morning, Mark. Thank you for having me.
I think that you come with a lot of experience in a lot of different areas. And, my guess is that, you see a lot of people who are paying too much in the way of taxes.
We do. We see it all the time. One area that we really see a lot of issues with is in the area of estimated tax payments. A lot of times people have Schedule C income, or they own an S corporation and have to make estimated payments on their personal returns. And what happens is either they don't make these estimated payments timely or make them at all. And then at the end of the tax year, when we're doing their income tax returns, they find that they owe penalties and interest to a large extent. For example, we've had one client who came to us recently from a previous accountant who he ended up filing not only filing his extension late, but ended up filing his payment late. The payment that he had to make with his extension was $132,000. Now, while the IRS recognized the fact that he did file his extension and did actually make the estimated payment with the extension, the fact that his estimated payment was late, he ended up getting fined with penalties and interest to the tune of about $22,000, because they go back to the beginning of time, or since April 15th rather, and assess penalties and interest from that time going forward to the due date of September 15th. So it can become very costly.
What I'd like to do is, that's really the essence of what if we will call it our mistake number one, right. Dealing with estimated taxes. So Joe, as we see here under mistake number one and the estimated tax payment area of questions, there really are, as as we summarize, three basic areas that you see where people make mistakes. First one being, no quarterly payments. That's a real problem, isn't it?
Yes, it is. And people just have a tendency to disregard the payments throughout the year, and they don't realize how important it is to make those payments because, again, as I had mentioned, the penalties and interest can be very substantial if they don't make these payments timely and in the right amounts. And
so the interesting thing here is, as people transition into retirement, many had not been accustomed to paying quarterly estimated taxes. So you really have to educate them and make sure that they understand what they need to do so that when April 15th comes around, they're not surprised.
Yes, Mark, and that's an interesting point about retirement as well, because we have also a lot of people who come in who are retired. They might be collecting Social Security, but they're also getting pension income. And we get calls all the time, well, how much money should I have withheld from my pension income? And we go through the exercise with them and give them a figure, because they can either do it one of two ways, with estimated payments, or they can call the pension company and have withholdings withheld from the pension payments so that they're not caught in a trap at the end of the year with having to, again, owe potentially substantial penalties and interest on that income.
And as as they get more educated and as the years go on, we also need to make sure not only that are they paying them, but they're paying them on time and they're paying them in the right quarterly sequence.
Yes, that is correct. And a lot of times people in everyday life, they lose track of these sorts of things. They forget to make the payments, whatnot. The other issue is when they come in at the end of the year, they have made their estimated payments, but then they might give us the wrong information about how much they made and when they made those payments. As a tax preparer, a lot of times we're only as good as the information that's given to us. So when we prepare the return based upon that information, sometimes they end up getting an IRS notice letting us know that, hey, look, yeah, you made the payment, but it was for the wrong amount and it wasn't on time. So it's always important to work with your preparer to make sure that you're giving them accurate and timely information so that you don't get hit with this additional tax liability.
So Joe, one of the tips that I know that I give my clients as they've transitioned into retirement is particularly for those where things have changed in their life financially. Either there's a big windfall or it's the first year in retirement and they're just not sure about whether they're on track to have paid the right amount, that in the fall, like September or October, that they call you to make sure that they are on track, and then you can help make any adjustments necessary for that fourth quarter payment.
Oh, absolutely, Mark. What I always encourage my clients to do is anytime, whether it's the fall or spring or winter or anytime that they're coming into an unusual or large financial transaction, to always give us a call first and talk us through it and let us know what's going on. Because a lot of times clients will make decisions regarding these transactions without consulting their accountant, and they end up owing a lot of extra money where we could have helped them save them a lot of money had they called us up front. Our job is to, as we say, your job is to make the money, our job is to help you keep the money.
Absolutely, absolutely. What we'd like to do is now move on to the area, the mistake number 2, which really is the Schedule C arena and for sole proprietors.
Yes, Mark. And mistake number 2, I was referring to Schedule C income in that area. And what I was trying to convey is the fact that in recent history, the IRS and more importantly, the Mass Department of Revenue has really been coming down on people with Schedule C income in terms of documentation. A lot of times clients will come in, give us their Schedule C information. And for those of you who don't know what Schedule C income is, it's those people with sole proprietorships. You might have a dog walking company, for example, or a car cleaning company, for example. Small businesses that, although they are very lucrative, they don't require incorporation. So people tend to have a tendency to fill out Schedule Cs. Well, what happens is when they're generating that income, they don't keep good books and records, and they don't have a lot of support for the types of expenses on Schedule C that they take. So just recently, we had a client come in, Schedule C income earner, high Schedule C income earner, and the IRS had sent him a notice that they wanted to audit his Schedule C. Well, he came in and sat down with us, and we tried to help him as best we could to go back and now try to recreate the wheel as best we could. But the IRS ended up disallowing a lot of expenses to the tune that the person had to pay about $22,000 tax bill because he couldn't substantiate his expenses. Yep. Now, that tax bill would have been a lot more had he not gotten us involved. But then what happens is because of the amount of time that we have to spend with that client, then he sometimes incurs a hefty bill with us as well, because this could go on for days, sometimes weeks, trying to resolve this matter. Yep. So we always tell our clients that when they come in for us to prepare their return and they give us their Schedule C income, the first thing I always tell them is that, look, make sure you have support for these items on this return, because if you get audited, you're going to be required to have to present those items. And the one area that they're really focusing in on Schedule C is the auto deduction. Sometimes people take the mileage deduction or they use actual expenses, but in either case, they really need to substantiate that number on that return so that if they do get audited, they're not going to end up having a huge tax liability. I also had another client too, not necessarily with Schedule C, but they were individuals that came in and they used to always itemize their deductions. They had a lot of non-employee expense reimbursements that they had to incur on their own. And year in and year out, that amount would be typically about $32,000, a hefty amount. Well, the Mass DOR came along and audited them and disallowed everything because they couldn't substantiate any of those expenses, even though we tried to help them do that. So people have to be very cognizant of that when you have Schedule C income, that even though you're not a corporation, you still have to keep very good, books and records so that in case any of those items do come into question, you have the support to substantiate them.
Joe, those are great points. And I think that one of the things, particularly as I work with those who are entering into retirement, they may find that their they may have some part-time income or have a part-time job. You mentioned, like dog walking or whatever it is they may want to do. And they may need to put together a new schedule that they were unfamiliar with before they had retired formally. So it's really important to take that proactive approach that you certainly do with your clients to make sure that they're aware of what they're doing and the impact of what they're doing before the end of the year, before they may find themselves paying some sort of large tax penalty. Which leads us into mistake area number 3.
Yes, Mark, and mistake number 3, and actually all 3 mistakes really tie into one another, and more importantly, in retirement, because as people's lives change, their income streams may change between making timely and accurate estimated tax payments, maybe starting a new business, a sole proprietorship, and having to make sure that you're substantiating all your expenses. And also the last one is just as important as Social Security. A lot of people go out and they retire. They say, this is great, let's take Social Security. And then they want to continue working. I mean, as you know, we live in a world now that's changing. More people are starting to work later on in life. And although they're collecting Social Security, many are under the impression that they don't have to ever pay taxes on that Social Security. But that actually is not true. As you can see on the screen, someone single or head of household with combined income, including Social Security, between $25,000 and $34,000, end up having to pay a tax up to 50% of this on 50% of their Social Security benefits. Then if you're filing a joint return, any combined income between $32,000 and $44,000, they have to pay tax on up to 50% of the Social Security benefits. So what we're finding now more and more is older clients come in and have their tax returns done. They decide to go out and get a part-time job, for example, a dog walking business. I actually had a client call me yesterday. They wanted to know the tax impact. They're retired. She went out, started a dog walking business. She made $11,000. Didn't know that she had to make estimated tax payments. Didn't know she had to keep good records because now she has a Schedule C. And now they're collecting Social Security and didn't even realize that that income actually may end up causing some of her Social Security benefits to be taxable. So these 3 issues all really tie together as people get older and start changing their lives and income streams over time.
And one of the areas, particularly for those who have yet to reach full retirement age, is what we call the annual earnings test. If you apply for Social Security before your full retirement age, and if you earned in the year 2019 more than $17,640, $1 for every $2 of benefits will be withheld for your Social Security. Now, that doesn't mean you lose it forever. There's a complicated formula that once you reach full retirement age, they start to give you some of that money back, and it may take a few years to get it back. But at the current moment, if you're, let's say, 64 and you're earning more than $17,640, you're not going to be keeping all of that. Not only are you going to have the Social Security benefit withheld, but as Joe just mentioned, your Social Security benefits themselves may be taxed. So Joe, I have an interesting story for you. It goes back many years ago. Let's call my client Bobby. Bobby wanted to take her grandkids to Disney. And she was working at, I believe it was Jenny Craig at the time. And she wanted another $7,000 or $8,000 in order to take the grandkids to Disney and have a great time and create all these memories. So fortunately, she asked me the question before she actually did it. In other words, before she went about and got more hours with Jenny Craig to earn the extra $7,000 to $8,000, she said, should I? So with her and her accountant, we got together and did the numbers. And would you believe that she sort of like hit the perfect storm with all the thresholds? And she had something in the vicinity of a 75% tax burden on the $7,000 to $8,000 worth of earnings she was going to earn to take the kids to Disney. So the reality was she was only after the $7,000 or $8,000 of gross earnings. She was only going to walk away with like $2,000 or $2,500. So we said, Bobby, It's not worth it. Don't do it. So it's really important to understand the impact of this. And if you do decide to change what you're doing, to call your financial advisor or call your accountant so you know ahead of time what the impact might be to you. And Joe, that's why, again, you have that proactive approach like we do with retirement with your clients.
Oh, absolutely, Mark. And you hit the nail right on the head. I mean, we see this all the time. A simple issue like a $7,000 item could turn into a major mistake if you're not consulting the right people at the right time, which would be me and someone like yourself. Case in point as well, just to add another story, we had a client come in recently. He was in business with his cousin, and he wanted to get out of the business. He wanted to sell his shares. So he came in and talked to us, and he was ready to take the deal for $600,000. He thought that was great. Well, he came in and sat down with me, and we went through everything. And it wasn't even necessarily the numbers. It was just how to sell a business, what is the business worth. We ended up making him another $400,000. So we ended up getting $1 million instead of $600,000.
Yep.
And I couldn't believe it.
Yep.
So it's all of that. It's so important that a lot of times people don't realize how important something or a financial decision may be, because the number may be small, but they, after coming in and speaking with us, then they realize, well, geez, they didn't think of that. They didn't think of this issue, and it could turn into a complete disaster for them if they don't consult the right people.
Absolutely. We've been talking with Joe Trainer here out of the Boston area, and I really appreciate the insights, and hopefully those who have viewed this video will figure out how to pay less in taxes than they should. If you're interested in learning more about how to put together a comprehensive retirement income plan for yourself, be it taxes or Social Security, investments in total, make sure to click on our Become My Client to understand a little bit more about what we do with our clients. You can find the Become My Client icon on our YouTube channel. And Joe, I want you to make sure that you give our viewers your contact information as well. So how can they get in touch with you?
Well, they can call us at J Trainer and Company at 781-279-7800. We're at 107 Audubon Road in Wakefield, Mass, right off of 128, an easy location. And we're here, our office hours are 8:30 to 5 typically, but I'm always very flexible with my clients. Some of them may not be able to meet during those hours, so I'm always early in the office. If they'd like to come in earlier or later at night, just give us a call and make an appointment and come in and talk with us. We'd love to see you.
Joe, thanks very much. I want to thank you for watching today. I hope this has been relevant to you and you can figure out how to reduce the impact of taxes. Please make sure to subscribe to our channel and forward this to some of your friends if you think that they would benefit from some of this information. Thank you again for watching, and I hope that you enjoy the retirement journey.